Hello everybody and welcome to Options Paycheck Live. Today I will be reviewing the open trades with special focus on Nvidia and Rivian. If you are new to the channel, I focus on practical options strategies to build a reliable second income. Please like this video if you find it helpful and subscribe to the channel to see my trades. Let's get started. Topics to cover today are: we will check the charts, and we will decide if trades need to be adjusted. Please put your comments and questions, and I will go through it and explain how I'm thinking about trades and how I'm reviewing trades to maximize my profit. All right, as I was saying, focus today is Nvidia and Rivian. You see on my screen my positions, and you see that my open options for Nvidia are one call option for strike price of $102, and then another call option with strike price of $115. The option with strike price of $102 was open previous week, and I rolled the option to this week as the price started to grow. If I have a look on the chart, I opened, this is Monday, I opened the option here, and then this line is showing $102 level. So obviously last week it was already above this level, so I decided to roll the option. It is interesting if we check the option that you will see the price. Let me just find it, the price. I'll show it to you. It's here. So cost basis is $549. What it means is I had to pay for rolling. I had to pay approximately 400 or maybe even close to $500 to get then back $549. So to roll the options is actually quite costly, and we can check also what it means if I want to roll the options. If I want to roll the options this week, you will see that it's really, it will cost really a lot of money. But let's have a look on the chart and decide whether it makes sense actually to roll the options, and whether, like, what is the price development that we can expect in the near future. So focus right now is on the option with the strike price of $102. Obviously, the price is going up. It's peaking, and potentially this price of 115 is resistance level. So there is a chance that again the price will start dropping, and therefore to roll the option would be good way how to keep the shares and still earn some premium. What it means is, imagine that and I will try to draw the lines here. Maybe this one will work. So imagine the price tomorrow will go to level somewhere here, maybe to $107 on Friday. Potentially, it would still be above $102 strike price, and I would be forced to sell the shares. However, if I roll the option, I will still keep my covered call with the strike price of $102. I would just roll the option forward, and there is a chance that the price will still be falling and potentially reaching somewhere close to the support levels or maybe a little bit above, but still there's a chance that the price would be below $102. So now what it means. To roll the option, basically the logic is that you buy the option back and sell immediately the option in the future. I'll show you. Unfortunately, I cannot actually roll the options directly in this web interface. I would need to either do it on mobile phone or do it in the application. And so, but let me at least show you the logic. So this is option for this week, and I have $102 strike price. As I was saying, to roll the option, I first would need to buy the option. The price to buy is $11.45. So it would cost me basically, because one option contract is 100 shares. So it would cost me $1,150 to buy the options. And then part of the rolling is also selling the options, right? So then I would sell the options and I would be just rolling forward. So keep the same price. So then I would sell for 175. So let me just go back to remember what was the price. So the price was 150. So I would buy for 150, sell for 175. So therefore, potentially 25 cents per share would be the profit, which means multiplied by 100. One option contract is 100 shares, so $25 would be profit. Do I want to do it right now? Well, I I will not do it right now. I will wait till tomorrow because I will potentially need less money as there is delta decay. Theta decay. So with the time running, the prices of options are lower, and I will need less money than 1,130 or $140. So let's wait for Friday and see the price development. But I plan to roll the options and really expect that the price might be dropping. Also, the reason to expect the price could be dropping are the gaps. So usually the gaps between candles, usually chart is closing the gaps. It might not be immediately, but in near future there is a reasonable chance actually that the gap will be closed. I mean, you can see it, for example, here, right? So here is gap, here is gap. Uh, Basically 2 3 days after the gap was closed. It's just one example that you can see here. Another one actually is here, right? So here is gap. 1 2 3 days later the gap was closed, and so on. So you will probably see here gap as well. It took maybe what is it, 2 3 weeks, but then again the gap was closed. So there is a reasonable chance that the gap will be closed as well. So rolling the option is a good idea, and I will do it tomorrow once the price will be a little bit less than one over 1,000 per one contract. All right. The other option contract I have for Nvidia is on with the strike price of 115. I believe that this one will just expire worthless, expire out of money. So if I look at the chart, this yellow line is 115. So if the price will be actually going above, I will roll the options. But if the price goes down or stays below, then I will just let the options expire worthless. Even though, as I'm talking about it right now, mm, there is good chance. There is good chance that if the price will be close to 115 and I roll the options, I will earn a lot of premium because of course premium is higher closer to the strike price. The more the farther or more away from the strike price, the premium is lower. I can show it you here. If I go to portfolio, Nvidia and options, you will see that the strike price, of course, for cover, and we want calls, right? So the strike price, um, the more far is the strike price for the current price, the less premium you will get, or potentially if you want to buy, the less money you need to pay to get the options contract. All right, so this was Nvidia. I will probably roll both options, but I will do it on Friday only. The second one I want to discuss is Rivian. And the Rivian, for Rivian, it is slightly different situation because for Rivian, I have put options with strike price of $10.50. So $10.50 is this blue line. I will make the line yellow just to make sure that we know that it is strike price of options. That's how I started to highlight the strike prices. And by accident, sort of, it is also the price of support. So 1050 is seems to be support for Rivian price. All right. So the put options, they will obviously expire out of money. I will not do anything with them. I will not be rolling them. I will just leave them as they are. And then I'm sorry, I have there also call options for $12.50. They will expire this Friday as well, and I need to decide what to do there. I can either leave it as it is and sell the shares. I will be selling the shares with profit because, as I was saying in the previous streams, I bought the shares somewhere around $11, so it's nice profit. However, I expect that Rivian will be hitting the resistance level somewhere here, and that this potentially is run before the earnings, right? So you can see that there is earnings. Also, we are close to overbought the territory on RSI, and so there is reasonable chance the price will be dropping, and it might be actually after earnings, it might be a quite significant drop. So I think it's a reasonable strategy to roll the options unless it's extremely expensive. Let me check Rivian. Rivian. So again, we will look at the options chain. Strike price $12.50. To buy options, I would need to pay 149. To sell, I would be getting 175. So yeah, I mean it's I have two contracts, so I would be paying around 300, right? So in this ballpark, so that's okay. It's not really expensive. I will earn $25 per one contract, so that's quite nice. And again, if I roll the options, I will not sell, so I will protect my shares, and I can still earn on premium if the price is going down and the resistance levels will keep. There might be surprise during the earnings. However, I would incline maybe more towards negative surprise given the situation with tariffs and so on. So yes, this was a review of the options. I wanted to show you what to do if the price is going above your strike price, if the price and the market is moving basically against the direction you would like to move it, and what options, what chances you have to adjust your option contracts, and how you potentially still keep your shares and earn money on the premium. All right, please comment the video, put your comments if you see it, like if put likes if you like the video. Don't forget to subscribe to the channel, because every Sunday I'm planning my trades, my option trades. On Monday I usually do a review of the executed trades and review of orders, and if there is any interesting development on the market, I connect and do live stream also during the week. So again, please like the video if you like it, subscribe to the channel, and I will be looking forward to connect with you again next week and plan the trades with you on Sunday. All right. Until next time. Have a nice day. Bye bye.